Welcome to your daily deep dive. It's October 24, 2025, and we're digging into the Bitcoin intelligence briefing. Okay, so let's get into it. Bitcoin pushed past $111,000 in the last day. On the surface, things look pretty stable, kind of in equilibrium. But our job today is to look underneath that. There's this real tension brewing, isn't there? We've got this macro optimism clashing pretty hard with some, well, concerning signals on-chain.
That's exactly the core conflict we need to dissect. You have the immediate story, which is this relief rally, really fueled by that cooler CPI data we got. But the deeper, maybe more structural story is this significant wealth transfer happening almost silently right below that key $113,000 level.
Right, and that's where it's fascinating. We're tracking these institutional players. They're calling them dolphins now, not quite whales yet, and how they're accumulating. And maybe even more interesting, there's a NASDAQ Q-listed company making a huge pivot, basically throwing out the old digital gold playbook for their treasury. It's quite the move. So let's start with those external factors pushing the price up. Bitcoin gained, what, about 2.38%? Got back over $110K?
Yeah, firmly back above that level. And the main spark was definitely the delayed U.S. September CPI report. It came in a little softer than expected.
Softer how? What were the numbers?
The annual rate hit 3.0%. Now, the forecast was for 3.1%, so just a tenth below. And core inflation also slowed down a bit from 3.1% to 3.0%.
Okay, only a tenth of a percent, but the market really jumped on that. Why is such a small beat, so significant for Bitcoin?
Well, it's all about Fed expectations, isn't it? Even that small dip reinforces the idea that the Fed might ease up. It makes another rate hike seem less likely, and maybe more importantly, it boosts the chances of a rate cut at the next meeting, October 28th, 29th. And historically, for assets like Bitcoin, perceived as risk-on, the hint of looser monetary policy, that dovish pivot, is just about the strongest external driver you can get.
Makes sense. And then there's the geopolitical side, too. Less tension, maybe?
Yeah, it seems that way for now. High-level U.S. China trade talks started today in Malaysia. They're running through the 27th. Markets generally see that kind of dialogue as reducing, the big, scary tail risks. It encourages risk-taking when it feels like the worst-case scenarios are less likely.
Okay, so macro looks better. But what about the technicals? Where does the price need to stay?
Right now, holding support around $109,000 is pretty key to keeping this momentum going. But the really big hurdle, the level that would truly validate this macro-fueled rally, is that overhead resistance at $113,600. That's the number everyone's watching.
All right, let's pivot now to what's happening inside the market, on-chain, because this is where that conflict really shows up. We've got intelligence from two big firms, Glassnode and CryptoQuant, painting slightly different pictures, but describing the same fundamental shift.
Exactly. And that shift is basically pain for the newcomers and opportunity for the long-term holders. Glassnode is flagging what they're calling market exhaustion. They point to the short-term holder cost basis. That's the average price paid by folks who bought in the last 155 days or so, sitting right around $113,000.
Okay, 113K again. So if we're trading below that, like we are now, mostly, those recent buyers are holding at a loss. Why is that specific STH level so critical psychologically?
Well, it represents the breaking point for that cohort. When the price dips below their average entry, the pressure builds. They're the most likely group to panic, sell, capitulate if the price drops further. Glassnode is essentially warning that if we can't decisively break above 113K, we risk seeing those weaker hands fold, which could push the price down towards support, maybe in that 108K to 97K range.
Okay. So that's the risk. But then CryptoQuant offers a counterpoint, focusing on these dolphins. Remind us who they are again.
Right. The dolphins wallets holding between 100 and 1,000 Bitcoin, they're generally seen as a good proxy for, let's say, serious mid-tier institutional capital or high net worth individuals consistently accumulating.
And what are they doing? Are they getting spooked below 113K?
Not at all. Their scale is, frankly, enormous. This group controls 26% of all Bitcoin in circulation. That's 5.16 million BTC. And what's really telling is their behavior throughout 2025. They've just kept buying. They've added a net 681,000 BTC this year, pretty much ignoring the short-term price swings.
Wow. So if you put Glassnode and CryptoQuant together, it sounds like short-term holders might be nervous, maybe selling, but the dolphins are just stepping in and buying those dips.
That's precisely the dynamic. It suggests market maturity, not the end of the bull run. You're seeing supply move from, let's call them higher time preference traders, the STHs, to lower time preference, more convicted capital, the dolphins. It's a structural wealth transfer playing out. For this dolphin cohort, yeah, they'd like to see a $115,000 break, But their real line in the sand, their deep structural support, seems to be holding strongly around $100,000.
Okay, stepping back from the immediate price action then. The whole long-term investment case seems to be changing too. It's not just buy and hold anymore.
Not for everyone, no. We're seeing a definite evolution towards more active, strategic uses of digital assets, particularly in corporate treasuries.
And this is where Greenlane Holdings comes in, the NASDAQ company.
Exactly. They just closed a big $110 million private placement. Polychain Capital led the round, which is significant itself. But the really interesting part is what they're doing with the capital.
Right, the treasury strategy. They're shifting to Barra token as their main reserve asset. They hold 54 million Barra now. That sounds pretty radical compared to just holding Bitcoin. Why Barra?
It is radical. This is what's being called the digital venture model. Barra is the native token for Barachain, which is a layer 1 blockchain focused heavily on DeFi, decentralized finance, using a sort of unique proof of liquidity consensus. By making Barra their primary reserve, Greenlane isn't just holding a passive asset like digital gold. They're making an active venture capital style bet on the growth of a specific DeFi ecosystem. It essentially turns their public stock into a way for investors to get exposure to early stage DeFi growth.
That sounds like a much higher risk profile, though, doesn't it? I mean, moving from Bitcoin stability to a protocol token, Polychain's involvement suggests confidence, but it really changes the game for Greenlane.
Absolutely, the risk is much higher. But so is the potential upside if Barachain takes off. It shows institutions are becoming more sophisticated, willing to take on specific protocol risk for potentially much larger returns. It's a clear departure from the simpler, let's say, MicroStrategy model of just stacking sats.
And for companies to even attempt strategies like this, they need the right tools, the right infrastructure. Are we seeing that develop too?
We are. Look at Tap Global's BTS platform, Bitcoin Treasury as a Service. They just signed up their second publicly listed client, London BTC Company. This service provides the essential plumbing secure trading, fiat on-ramps, compliance support that companies need to manage active crypto treasury strategies. It shows there's real commercial demand now for these complex services.
Interesting. And meanwhile, another big strategic shift seems to be happening in the mining sector. They're looking at AI.
Yes, definitely. This is driven by hard economics. The estimated average cost to mine one Bitcoin is hovering around $92,000 now. With the price at, say, $111,000, especially after the halving reduced block rewards, miner profitability is getting squeezed, so they need other revenue streams. And they have this huge advantage: massive data centers and access to relatively cheap power. Repurposing that infrastructure for high-demand, high-margin AI computing makes a lot of sense financially.
But does that pose a risk? If miners divert resources away from securing Bitcoin towards AI, could that weaken the network's hash rate or security?
Not an immediate existential risk, probably, but it fundamentally changes their business model. They're decoupling their company's success, their stock price, from the day-to-day price of Bitcoin.
Right.
They leverage their existing assets for AI, which is booming. It's a smart survival and diversification play for them, making them less vulnerable if Bitcoin's price stagnates or dips. It ensures they can stay profitable.
So all this change, this maturation, it needs support, both conceptually and practically. We saw the new A16 State of Crypto report calling 2025 the year of institutional adoption.
Yeah, and the data in that report really backs it up. They highlight over $175 billion globally now held in Bitcoin and Ethereum ETPs. That's a huge number. And look at stablecoins processing something like $9 trillion in adjusted annual volume. That's starting to rival payment giants like Visa. It shows real integration is happening.
And to handle those kinds of flows, the exchanges themselves need to scale up significantly, like Bybit increasing withdrawal limits.
Exactly. Bybit bumping daily withdrawal limits for their top institutional clients up to 60 million USDT per day. That's serious capacity. It signals they're not just coping with current demand, but actively building the pipes for much larger institutional money they expect to come in. It's about providing that prime brokerage level of service and liquidity assurance.
And just to touch on the political angle quickly, we saw President Trump mentioning his pardon of CZ, the former Binance CEO, yesterday.
Right, he defended the pardon, saying Zhao had a lot of support. Regardless of one's view on the pardon itself, it just underscores that crypto remains a very visible topic in high-level political discussions. Policy and regulation are clearly still very much in play.
Okay, let's pull this all together. We have the CPI data giving some short-term relief, maybe taking some pressure off those short-term holders around that 113K mark. But the bigger underlying story seems to be this steady, relentless institutional accumulation, the dolphins soaking up supply, building for the longer term.
That's the key takeaway. So for you listening, the actionable things to watch are, well, twofold. First, keep a very close eye on how the price reacts right at that $113,600 resistance. That STH cost basis is the big psychological test. A clean break above could unlock more upside. Second, watch for any early news or even just sentiment shifts coming out of those U.S. China talks in Malaysia. Geopolitics will definitely steer risk appetite as we head into the weekend.
And maybe one last thought to chew on as we wrap up this deep dive. Think about those miners pivoting to AI. If they increasingly fund their operations, their security infrastructure for Bitcoin, with high-margin AI revenue, how does that fundamentally alter the incentive structure for securing the network long-term? If securing Bitcoin becomes almost a byproduct, subsidized by AI, what does that mean for Bitcoin's own economic model and maybe even its supply dynamics down the road?
It could make the hash rate incredibly resilient, actually, less dependent on the token price cycles. It decouples security costs from block rewards to some extent. That's potentially a massive shift in the network's economics, something that could really define its next phase.
A fascinating question indeed. We'll keep tracking all these moving parts for you. Thanks for joining this deep dive.